Good evening, friends, and welcome to yet another very interesting session to learn on the international tax. And this time, we are going to learn on transfer pricing. We have our guest speaker today, Dr. Raffaele Petruzzi, and he is going to take us through the two interesting decisions which have come in the intra-group financing. One is Australia versus Singtel and United Kingdom versus BlackRock. Friends, transfer pricing has been a very interesting topic for all of us to discuss and deliberate, and there are a lot of developments taking place in this arena. And we are really thankful to Dr. Raffaele for readily agreeing to address us, and we are also fortunate to have Karishma to chair this session. And thank you, Karishma, for the for chairing this session. And I request Karishma to take it forward. Over to you, Karishma.
Thank you. Thank you, Mohammed. Thanks to IFA for giving an opportunity to chair the session. And thanks, Raffaele, for joining us despite a busy schedule between practice and academia. So we really appreciate you spending time. So let me just quickly introduce Raffaele for the session today. So Raffaele is basically the managing director of WU, which is the Vienna University Transfer Pricing Center at the Institute of Austrian and International Tax Law, the founder and CEO of Petruzzi Advisor, and an independent advisor on international tax and TP matters. He's also a member of the United Nations Subcommittee on Transfer Pricing. Raffaele has gained extensive experience by working for many years with, I think, all the big fours, international tax law firms, and in-house positions. He's a frequent speaker in international conferences and lecturer of numerous courses all over the world, as well as author of many publications. Amongst others, he's an editor of Linde Transfer Pricing International Journal and a member of the International Fiscal Association, that's IFA, and of Transfer Pricing Economists for Developments, which is the TPED. Raffaele holds a PhD in International Business Taxation from the Vienna University, an LLM in International Tax Law, again from the Vienna University, and an MSc in Business Administration and Law from the Bocconi University. So, welcome, Raffaele, and over to you to take us to two very interesting judgments which really involve the core issue on deductibility of interest payments in loan transactions. And these are like your financing transactions, which is fairly seen in most of the cross-border transfer pricing arrangements that you see from amongst various multinationals. So I think this issue will be very relevant for all multinationals having related party financing transactions. So over to you, Raffaele.
Thanks a lot, everyone.
So sorry, before you start, I'll just, although Karishma ma'am needs no introduction, everyone in India who's working in transfer pricing knows her, but just a brief introduction that she is she manages and leads the tax controversy and transfer pricing practice at Deloitte in India. And she has previously had the similar role at KPMG, BMR, and at Grant Thornton. And she was part of PwC's practice of transfer pricing practice from its inception for the first 5 years. She's part of our very own IFA India WRC, and she's part of the executive committee. And she's a regular speaker at various events, and including the global plenary in 2019 IFA Congress. And she was also named as one of the top 10 transfer pricing advisors in India by International Tax Review. So someone great to chair our session. So thank you, ma'am. Sir, I'll hand over the session to you. You can please take it forward.
So, thanks a lot, first of all, everyone, for the invitation. I think it's really much appreciated, and always happy to talk about transfer pricing issues with transfer pricing experts. So I hope we can have a meaningful discussion, an interesting presentation for you. But please feel free to ask questions, feel free to let me know your views. I will basically present two cases on financing that have some similarities, some differences. Two cases decided in two different countries, both of them being common law jurisdictions. But I guess the outcomes of these cases might have some interesting impacts also on other countries, including India. So that's why I find these two cases pretty recent, recently decided, something to be discussed. I'll go one by one, so I'll present the first case, and then you will be able to ask all the questions, make all the considerations you want, and then after this Q&A, we go into the second case, and we will do the same. So let me see if I'm able to share my screen. Okay. I think this is. I wanted to start with case 1, and this is case 1. Okay. So sharing screen here. I hope you can see the case. So the first case is the Singtel case. It's an Australian case, recently decided in 2024. Not sure whether that's the last decision we'll see on this case, but it has a long story so far. So yes, this is just some announcements before. So facts of the case. We have Singtel, it's a Singapore-based telecommunication company. I think all of you know Singtel, and they basically have subsidiaries, SAI, and this subsidiary was controlling SOPL, an Australian company, and STAI was another Australian company controlled directly from Singtel. And after they made a restructuring, basically STAI was now the owner of SOPL, and in order to buy the participation in SOPL, STAI asked for a loan to SAI, actually a loan that was quite complex, and we'll see in a second what the loan is about, and it pays interest to SAI. I'm simplifying the facts of the case as much as possible so the case can be understood as clear as possible by all of you. So what was this loan about? And this was somehow the loan, the Intra-Group transaction that was under scrutiny in Australia by the ATO. This loan, called Loan Note Issuance Agreement, we'll refer to it as loan or LNIA, was issued in 2022 for an amount of 5.2 billion of Australian dollars, and it had an interest rate initially of 1-year bank bill swap plus 1% plus a gross up of 10% for the withholding taxes. just for those of you that are not from Australia, this 1-year bank sweep loan, bank bill swap corresponds to the LIBOR. So one peculiarity of this loan, and this is very important to know, is that the interest were accruing from the commencement, from the initiation of the loan, but was payable only if SAI was issuing a variation notice to STAI. So meaning that the interests were payable only when STAI was profitable, surely not in the first years of the loan. And as for the repayment, this loan could be repaid anytime, and the lender could have requested the repayment of this loan at any time. Now, you see already some peculiarities in the way that the conditions of this loan were framed and were included by the taxpayer. But after this initial agreement, the taxpayer started amending this agreement. And so after nearly 6 months, the taxpayer included a maturity of 10 years in the loan agreement. That was the first amendment, not really relevant up to now. But what was a little bit more peculiar, more important for our discussions was the second amendment. That happened basically less than a year after the first loan agreement. And what was this second amendment about? Basically, in this amendment to the loan, there was a forgiveness for all the interest payment that were due, including no withholding taxes, and the taxpayer included a profitability benchmark with retroactive effect, meaning that basically if the borrower was profitable up to this profitability benchmark, then the interests were payable. But if it was not that profitable, then no interest and no withholding taxes were met. Of course, in this case, the interests were not accruing regularly, but the interest payment was depending on the profitability benchmark. And the taxpayer said, well, since we have forgiven all the previous interest payments, and we have now included an element of uncertainty over the accruance of the interest, we will amend also the interest rate, and we will add a premium of 455 basis points, otherwise 4.55% of the principal, to consider all the missed interest payments in the past and in the future. Then, after a few years, the taxpayer made a third amendment, and in this case, the taxpayer decided to fix the interest rate to a much higher rate, 13.2%, and you see it here. So the transaction started complicated, but soon it got even more complicated, and that's why the ATO started questioning this transaction. And between fiscal years 2011, 2013, it disallowed about 900 million of Australian dollars deductibility of interest payment. That corresponds, that had an impact of 300 million.
डिडक्शन करने की बात हुई थी कि हमने क्या किया लास्ट एक्चुअली से नहीं किया डिडक्शन
Nilesh, do you have a question or
Nilesh, I think you'll have to just, Nilesh, you'll have to mute your line and your video. It's got on.
So if there are no questions, I will continue. So basically, the taxpayer had an impact from this tax assessment of 300 million extra taxes, interest, and payments, corresponding to pretty much $200 million. And the issue was that the ATO basically said this 4.55% interest premium that you have calculated in the second amendment to the loan was calculated based on something very unreliable, based on very unreliable assumptions, and this is something that two independent parties would not have done, and so they disregarded most of the deductibility of interest payments. I hope the facts of the case are clear, but if there are some questions, please let me know, because if we don't have clear the facts, then we will not understand the discussions later on. So what happened? The taxpayer and the tax authorities brought forward some considerations. Most of these considerations were made actually by expert views on the topic. The taxpayer said, well, since the beginning of the transaction, it was pretty clear that the borrower would not have paid those interests in the short term. So the premium that was added was basically something that you should have considered since the beginning of the transaction. And then they asked the view of an expert on this, an expert from the financial sector. And this expert said, well, if we have a look at this transaction, it seems that this is typically something we cannot assess as based on the real transaction, the transaction that was actually entered into by the taxpayer, but we should consider an hypothetical transaction. What would be this hypothetical transaction? It would be a 10 years US debt capital market with a cross-currency interest rate swap, because it was an Australian loan, based on the following assumption. First of all, the expert came up with a credit rating between BB and single B plus on a standalone basis, and between BBB and BB with an implicit support. It also said implicit support should be considered. So the rating of the loan of the transaction was between BBB and BB. But he said no parental guarantee should be considered. And if we consider all these assumptions, so a 10 years US bond with cross-currency interest rate swap, the rating of BBB and BB, implicit support and no parental guarantee, we come up with a credit spread of around 400 basis points. And then the expert said, if we consider the effects of the actual transaction over 10 years being approximately 144 basis points, plus the withholding taxes gross up, then we see that the taxpayer in Australia paid less than what an independent party would have paid, and so the transaction is at arm's length. This is the analysis provided in favor of the taxpayer. Tax authorities, on the other hand, had a different view, of course, said, first of all, the loan was commercially irrational. They said that independent parties would not have agreed on the conditions defined in the loan, including all the various amendments, because those conditions were pretty unreliable for the taxpayer. And they also involved an expert opinion, and they also asked for an expert view on this, and the expert made a different exercise than the other expert, the taxpayer expert. The expert said, this loan would not have happened between two independent parties, so we cannot assume all that was done by the expert from the taxpayer position, but we have to consider what are the options realistically available. So based on the options realistically available analysis, the expert said we should imagine a different financing structure. The expert came up with completely different transactions between the borrower and the lender, and said, well, if we start from a rating of BB standalone basis and single A plus and single A with implicit support, and we include implicit support. So the rating discussion and the implicit support discussion was not something that the two experts argued too much, and there was not that much difference between one and the other in the analysis. But the second expert said the parental guarantee should be considered. So this was a main difference, apart from the fact that the second expert, the tax administration expert, took into account a completely different financing structure. Then the interest expenses should have been 1.23 billion Australian dollars lower. So the different views of the different experts were very radical. So one was saying this is something that is very much arm's length. The other one was saying this is something completely different from an arm's length result. And so the view of the court was based on these two experts' opinions. The first instance came in 2021. It was a long case already. It was a long judgment of 120 pages. And the judge, in a very much, I present to you in a very nutshell, said, first of all, we should consider implicit support. And the taxpayer's opinion and the expert opinion from the taxpayer is a little bit better on this because it was based on an analysis of reflecting S&P and Moody's criteria. So taxpayer and the opinion of the expert from taxpayer side used this bottom-up approach, and the court liked this approach better. So on the credit rating, the taxpayer and the expert opinion of the taxpayer was more appreciated. However, on the interest rate, the judge said two independent parties would not have agreed on the conditions and on the amendments because they were very unpredictable. It also said the parental guarantee should be considered, although strangely enough, no guarantee fee should be paid. And the judge said the interest rate of the original loan should be the one that should have applied for the full duration, for the full maturity of the loan. So the appeal of the taxpayer was dismissed in the first instance. So the taxpayer went and presented an appeal and went in the second instance, and this happened in 2024. So this was the recent judgment there. It's a judgment of 87 pages, so another very long judgment that to a large extent recalls the view of the first judgment, but also in the second judgment, the taxpayer brought a lot of new topics, a lot of new discussions there, a lot of new points, but the judge simply confirmed what was said by the first instance judgment, said, well, sorry, but this loan is not something that would have been entered by related parties, especially by independent parties. So especially the amendments to the law are not something that two independent parties would have accepted. And so the second judge accepted what was said by the first judge and dismissed taxpayers' ground of appeal. Now, just few final considerations before opening to questions and discussions. I think it is very interesting to notice the impact of expert opinions in these two judgments by the first instance and the second instance, because the court really much took into account these expert opinions, and the judges made pretty impressive efforts to understand all these complex financing issues. So that is something that comes as an interesting point for the future as well, where probably expert opinions will be those who are deciding the entire case. Another point to highlight is the importance of setting up contracts and carefully consider future amendments. So if you look at the way that the taxpayer set up initially this transaction, it was something that was very unpredictable. It was done in a way that the interest payments would have been very unpredictable. They even forgot inserting in the first loan the maturity date. And then after less than a year, they even changed this with the second amendment, and then they changed it after a few years with the third amendment. So all of this underlines the need to correctly set up the contract since the beginning, because if you set them up not rightly at the beginning and then you start amending them because you find mistakes or things that can be improved, then you can be challenged by the tax authorities. In-place support, this is something that both experts said it should be taken into account, and also the judges confirm that. But of course, the quantification of in-place support is something that still remains also in practice a big and important question. There's more and more discussions between taxpayers and tax authorities on how to quantify the in-place support. Historically, rating agencies' approaches have been used in practice. Some guidance out there. Also, if you look at the chapter on financing of the UN manual, gives some more guidance on the quantification, but still, this is a highly debated topic between taxpayers and tax authorities. UCD transfer pricing guidance were considered, and the judges, took them as relevant. Question is whether they can always be considered as relevant, especially countries that don't embrace those guidance. And as far as I understand, many countries do not have those guidance as embedded in their national legislations. So the question is whether this guidance from the OECD will always be considered relevant in your discussions with tax authorities and eventually in court. Another important point is the relevance of options realistically available. Now, this is something that is a very difficult topic. The OECD guidance speaks about options realistically available in several instances. It's something that was developed especially within Chapter 9 on business structuring, and then it was incorporated in Chapter 1, meaning that this notion of options realistically available applies to any type of situation, not only to business restructurings, but potentially applying them broadly can be very detrimental, because if you consider what could be an option realistically available, then you can start imagining new transactions that have not taken place, and so you really can disregard or reassess transactions between related parties in easy manner. So I think the notion of options realistically available is something that should be used very, very carefully in discussions between taxpayers and tax administration. And even when we consider the options realistically available, it is right that one of the options realistically available, as the expert opinion from the tax administration side underlined, was to imagine new loans, new type of getting money for the borrower, but also another option realistically available could have been to repay the first loan and then enter into the other loans. So this is more of a point that the taxpayer could have brought forward, but it did not, at least so far. Parental guarantee, this is something that the tax administration said it should be considered, and the court also said it should be considered, but the question is whether it can really be provided without any guarantee fee. So yes, probably a parental guarantee could be considered, but then you should also give the chance to the taxpayer to deduct a guarantee fee, unless the parental guarantee is a shareholder activity. Last but not least, I think there is a strong focus in this case. We'll see differently from the next case. Here there is a strong focus on pricing. There are probably more discussions on delineation, recognition, and method selection that could have been done, and probably the story would have been different if more emphasis would have been made on these other important aspects of transparency analysis. So here you have the judgments. For those of you who want to read all of them, you can click on these judgments when you receive the presentation, and then you can download them. And last but not least, I leave you my contact details. These are the contact details of my advisory company. You can subscribe to the newsletter and follow us on LinkedIn if you want to listen to more cases in the future. So I am done with the first case. Probably we can open to questions and discussions from anyone who feels interested or feels the need to discuss. I will leave the slides on in case something needs to be explained, maybe looking back to the structure. Any questions?
So I have a question. In this case, the argument was that the transaction undertaken wasn't what someone in an independent position would normally undertake. So there was a discussion of considering a hypothetical situation as an alternative. Now, do you see the risk that in these kind of cases, it would end up recharacterizing the transaction or making you using something completely different from what the conduct of the parties actually is, and that could lead to tax implications which aren't possibly consistent with what the actual conduct of the parties are. So just maybe if you could say something on that.
It's an interesting point, and of course, I answer based on the OECD view on this. The country-specific view might be different, but in general, when talking about recharacterization, this is a very dangerous word. The OECD guidance tends to stay away, at least in the last version of the guidance, from using this word. The OECD was using this word in the previous guidance. The UN manual still uses this word, so recharacterizing something is something very dangerous, because when you recharacterize something, you basically go beyond the scope of a transfer pricing rule, in my view. When you recharacterize something, you not only tell me something is not a transaction is not a transaction that would have happened between independent parties, but you also tell me what could have been in place of that transaction. And so there is something that probably guidance as a soft law tool should not do. It should rather be the national legislation of a country allowing to recharacterize something. So the OECD and the UN to a certain extent uses the word non-recognition. So basically says if a transaction is something that would not have happened between two independent parties, then I would not recognize it, meaning that I would not recognize the effects of that transaction, full stop. Then I don't tell you what should have been in place of that transaction, because again, that's something that national legislation should do. But yes, I think in the future, more and more discussions will come on these aspects of the guidance that talks about non-recognition, because especially in cases of financing, it is pretty easy to say this transaction would not have happened between two independent parties, so I disregard entirely the transaction. However, the OECD also makes a relevant point here, and it says, if you are able to find transactions similar to yours between independent parties, then you should not disregard and not recognize the transaction. So you should allow for the transaction to be recognized. This is something that probably more and more will work as a rule that will allow taxpayers to defend their transactions by simply making reference to third parties' behaviors when proofs are available. So I don't know if I answered your question. It's a very complex question, and unfortunately, I can only tell you that it will come more and more in future discussions between taxpayers and tax authorities.
So there is one more question, Raffaele, that comes to my mind is that, financial transactions are generally entered into for a long term, and the terms, the conditions are not revisited on an annual basis, right? But one of the points that the judgment mentioned, the second judgment, was that, look, you need to look at this more annually than at the end of the transaction. So, what are your thoughts on that? Because, even the OECD guidelines do talk about long-term contracts, and, it's more of price setting versus price testing. And in a real life situation, you may not have the option to revisit these terms on a annual basis, right? So, how would you look at that?
This is another important point that indeed the judge of the second instance made. He said you should not have a look at the 10 years impact on a transaction, but you should have a look at the impact that that transaction has on each year, because what the taxpayer said is yeah, it's true that at some point we start paying this high interest rate of 4.5%, but in the first years we didn't pay any interest because we were not profitable. So if we take into account these interest payments and we spread them around in the 10 years, then we come up with a much lower interest payment. And the taxpayer and the court said, no, you should not do this. You should not spread the impact of your transaction over the years, but you should rather look at the impact of the transaction into each year. Pros and cons in both approaches. I don't particularly tend to argue in favor or against any of these approaches. I think it really much depends on the national legislation of countries. But indeed, taxpayers' transactions, related party transactions, usually have effect on multiple years. So if you as a taxpayer know that those transactions are having effects on multiple years, you should try to make the impact of those transactions as balanced as possible over the years, rather than having no payments at all in the first years and then a one-time payment in 1 year, and then if someone comes and argues against that payment, you'd say, okay, yes, but I didn't pay anything in the past. So this is something that might be scrutinized in the future discussions with tax authorities as well. So try to make it as predictable and as constant as possible. So, or at least not making too huge differences between 1 year and another in your transactions, because then you might have big questions. I think the main issue here was the uncertainty and unpredictability over when those interest payments were going to be paid. Some national legislations, specific avoidance rules on loans and financing, may even tell you this is not a loan, this is equity, because you pay interest only when you're profitable. And indeed, I think the OECD guidance on chapter 10, I think paragraph 12 says there are certain conditions in a loan that might make it smell like equity, and the unpredictability over the interest payments is one of those conditions. So yeah, in general, in this case, I would tend to sympathize with the judge, because yeah, probably the taxpayer could have done it better. They could have set up these contracts in a more predictable way from the beginning, and those challenges would not have probably come. So yeah.
We did see a lot of these amendments and the terms getting changed, especially in the COVID and the pandemic period post that there were many contracts and many clients who had approached us to make amendments to the agreement. So this issue, I think, will be quite relevant in that sense. And I think the other interesting thing that you spoke about is about the implicit support. How do you factor that in, right? How do you put a value to it? Because, for example, implicit and explicit support was again a big matter of debate under Indian jurisprudence in transfer pricing, that when a corporate guarantee is given by a parent company, what form of guarantee is it? If it's explicit in nature, obviously it was covered. If it's implicit, it more than covered. But then obviously there were some amendments in the law that were made that covered both. But on the corporate tax side, we have high court judgments which say that, look, things like letter of comfort, which is like an implicit guarantee given by the parent company, that should not be treated as a guarantee. So again, it's very fact driven. At least, we've yet not seen a consistent view emerging from a jurisprudence standpoint in India. But I think, as you rightly pointed out, the OECD PP guidelines would also give us some directions there, and some of these cases.
Yeah, I think the implicit support issue is something that was discussed already since the G Capital Canada case, and then in many other cases, including in Australia, the Chevron case, other cases around Europe as well. It ended up in the OECD guidance. The OECD said, yes, you should consider implicit support, but there is not much said about how to quantify it. In some cases, countries have argued for group rating as the default approach when you have complex situation, but group rating, in my view, is not an arm's length, because arm's length requires you to make the effort to imagine an unrelated party situation. So group rating necessarily deviates from the arm's length principle. But in some cases, you can use group rating when you have a very important subsidiary for the group. On the other point of changing agreements, that's true. I think taxpayers regularly change their agreements. There is nothing wrong with doing that. I think in real life, we see it all the time, also between independent parties, at some point renegotiating agreements. But it is important that when you change those agreements, you do them based on a third-party behavior. So you really have to ask yourself, would two third parties have changed this agreement? And secondly, under what conditions? And this is something that in this specific case, it was questioned by both tax authorities and the courts. So, yeah.
So there are two, just for the attendees here, there are two Bombay High Court decisions. One is in the case of Z Entertainment. This came sometime in 2020, August 2020, I think. wherein it was held that a letter of comfort can be termed as a guarantee only if certain criteria under the Contract Act are fulfilled. So, that was one debate. And then from a transfer pricing perspective, we have the very famous Bombay High Court Everest Canto cylinders judgment, which held that a corporate guarantee cannot be compared with a bank guarantee, because to factor in a guarantee element, you can't take bank guarantee for TP benchmarking. And recently, we have seen the tax courts, which is the tribunals, they are looking at more interest saving approach to benchmarking guarantees. So I think a lot of these mixed things are there. But yeah, I think this is very helpful, Raffaele. If anyone else has any question, or else we can move to the second case.
There is one question.
Yeah.
The question says that the recent trends post Chapter 10 of the Income Tax Act on financial transactions, there's an emphasis on debt capacity analysis. So, do you think that, given a case of such an analysis, there would have been a change in the outcome of this particular judgment?
Yeah, I think in this case there was no direct reference to debt capacity analysis, but the two independent experts, or the two expert opinions from tax administration side and taxpayer side, both had a look at the rating of the borrower, and both confirmed, and let me see if I can go to the slides. So both confirmed that considering implicit support, the rating of the borrower was something above the investment grade. The investment grade is double B. So here you see the rating identified by the expert opinion of the taxpayer was between triple B and double B. The one in the case of the tax authorities was between single A plus and single A. So above that would be non-investment grade. So the debt capacity analysis, something that comes as embedded into the rating analysis. So in the rating analysis, you try to make the efforts of understanding what the credit risk of the borrower is. At the end of the day, the rating is a representation of the credit risk of the borrower. And in order to understand the credit risk of the borrower, you should take into account also debt capacity. So probably doing a specific debt capacity analysis would not have changed much, at least on the discussion on the rating, the outcome of the cases. I don't know if that answers all the questions.
So there's just one more question which has come up. The question is that, what are your views on benchmarking corporate guarantee transactions by a loss, given that the default approach, loss by a loss given default approach instead of interest saving approach?
Mm-hmm. So what is the first approach you said?
Corporate guarantee transactions based on the loss. Loss given default approach.
Okay, yes, okay. So yeah, guarantee can be priced in many different ways. So the typical way to price a guarantee is looking at the cost benefit analysis. So you look at the cost that you would incur in case you have a default, and so that is the probability of default approach. You basically multiply the probability of a default for the loss that you have in case you default, and that is the cost side of the range. And then you have the benefit analysis. The benefit analysis means you look at the benefits that the borrower gets from having the guarantee. So what would have been the interest that the borrower would have paid without the guarantee, and what is the interest that the borrower is paying with the guarantee, and that's the benefit part of the analysis. And you say, okay, the guarantee fee should stay between the cost and the benefit, and that is your range. There are other ways to price guarantees, especially when you have upwards guarantees. Then the cost-benefit analysis might not work that well. Then you have other methodologies. You could have CDS, credit default swap analysis, where you look at the cost of a CDS for similar or a borrower with a similar rating. CDS are something pretty relatively easy to identify, but they are pretty volatile because in some periods, historical periods, they are used for speculative purposes. So CDS analysis might not always be the best, but is a good alternative, quick and dirty, that you see applied as an alternative to the cost-benefit analysis. And then there are other approaches, the cost of insurance and so forth, that yeah, you might have there. But yeah, there's various approaches. If you read the OECD guidance and the UN manual, they tell you a little bit more on these approaches. Okay, so should we go ahead with the next case, or there are more questions?
No more questions.
What's the next case?
Okay. So I think we have only 30 minutes left, so I will try to be very concise and present you the second case. That is the BlackRock case. This is a UK case, also started some years ago already and decided recently in 2024. Another case on financing. You'll see some commonalities with the previous case, but also some differences. So also here, you know, BlackRock, I think I don't have to explain you what this company does, and they basically are a US company, and they bought some parts of Berkeley's business, and the question, or at least the issues, were about the US part of this newly acquired business. So in order to acquire this this business from Berkeley, BlackRock set up complex structure. First of all, we have here BFM Inc. That is somehow the treasury of the group, and then between the BFM Inc. and the target company, they established various companies. All these companies were based in Delaware, you see LLC 4, LLC 5, LLC 6, and Delaware Holding Inc. And all of them were basically also tax resident in the US, apart from LLC 5. LLC 5 was tax resident in the UK. And basically here, if you look at this structure, you say, okay, what's wrong with this structure? They just put a lot of companies in the middle, but the substance is that BlackRock ended up in acquiring BGI US. Now, the issue was around an intra-group transaction, actually various intra-group transactions, various loans that were provided by LLC4 to LLC5 in order to finalize this this acquisition of the shares. So while all the other flow of money were basically some equity transactions, in this case, the transaction between LLC4 and LLC5, taxpayer decided to borrow money and to ask for interest payments. Let's go a little bit more into details of the transaction. Clearly, this is a debt push down. And there were four different loans. One of them being short term. The issue was 2009. The total amount of these loans were 4 billion. The maturities between 1 year and 10 years. The interest rate between 220 basis points and 662 basis points. No covenants. This was an important element of the analysis, the fact there were no covenants. And as I said before, all the various entities were incorporated in Delaware and tax residents in the US, except for LLC5 that was incorporated in Delaware but tax resident in the UK. Why did taxpayer do that? Apparently because, first of all, the income from the shares received by LLC5 was exempted, but the losses they were making by paying the interest to LLC4 could have been deducted by other UK companies of the group via a group relief mechanism. So this ended up in having a good tax benefit for the taxpayer that the HMRC in the UK didn't really like. And so tax administration assessed fiscal year 2010-2015, completely disallowed the deductibility of the payment, and they used two rules to disallow this deductibility. Say first transfer pricing rules and then the unallowable purpose rules. Just for those of you who are not very familiar with the UK tax rules, the unallowable purpose rules are rules aimed at punishing interest payments when there is the purpose of the loan is unallowable. Simply, it does not have much commercial rationality, and you are doing that only for tax purposes. The main point brought forward was that independent parties would not have entered into such a transaction under such conditions. So you see here some commonalities with the previous case. What was the taxpayer's view? Also here, based on experts' opinions, the taxpayer said an independent party would have been willing to lend this money, but it would have required some covenants in order to lend this money, and an independent borrower could have borrowed this money, but it would have also agreed on different terms and conditions. What are these different terms and conditions? Typically, covenants. The expert from taxpayer side said covenants is something that could have been inserted into this agreement. It would have been pretty cheap and straightforward to insert it. So, yeah, no problem with hypothesizing a transaction including covenants, and parental guarantee is not needed. So LLC filed to the taxpayer said that independent parties would have been willing to agree on a similar transaction if covenants were included. On the unallowable purpose test, the taxpayer simply said that there is commercial rationality in this loan, that is to facilitate the acquisition of the business from Barclays. Tax administration expert opinion was different. Well, on the first 2 points, it was similar to the taxpayer's expert opinion. Said an independent lender would have been willing to lend if covenants are included, and a borrower would have been able to borrow under different terms and conditions, however. But then the expert opinion for the tax administration side said that I don't think providing covenants in this case would have been that cheap and straightforward. It's actually a costly and complex exercise, but not a deal breaker. This is something that made the judge a little bit puzzled. And the parental guarantee would have been needed anyway. So the HMRC said that independent parties would not have been willing to agree on a similar transaction because covenants are not there. On the unallowable purpose test, the HMRC said there is no business purpose in this transaction, and the only reason was tax avoidance. So the case ended up in the first instance court in 2020. This is a 50 pages judgment where the judge said, first of all, let's use 2010 OECD guidance. Remember, the first loan was entered into 2009, when 2010 guidance were not there. But the audit concerned fiscal year 2010. Anyhow, the judge said we should use the OECD guidance, we should use the separate entity approach, we should not overreact with options realistically available. It also pointed out something important. It said that in a transfer pricing situation, it does not matter whether there is the purpose of obtaining a tax advantage or not. It said transfer pricing exercise is more about assessing whether you've allocated the right amount of taxable income in the various countries, so it's not about tax advantage. And it's more about asking yourself whether an independent party would have entered into such a transaction and under which conditions. So the first instance court said that because two independent parties would not have entered into the same transaction, it's important to hypothesize a different transaction. And now, if we hypothesize transaction having covenants, then two independent parties would have entered into a similar transaction. And so the judge was more convinced by the taxpayer expert opinion. On the unallowable purpose test, the judge said that there was commercial and a tax purpose, so not only a tax purpose, but also a commercial purpose in having this law. So the judge ruled in favor of the taxpayer. Of course, tax administration appealed, and in 2022, there is another judge of 50 pages where the judge said something different. He said, well, first of all, we should use the 1995 guidance because transaction was entered into 2009. Secondly, that when we hypothesize a different transaction and one entered between the taxpayer and the related party, then we are changing the nature of the transaction, and this is not something that we should do. We should look only at the transaction that is actually taking place between taxpayer and the related party. And since that transaction would not have taken place because of the absence of covenants, then I do not agree with this transaction being arm's length. On the unallowable purpose test, the judge said there was no commercial purpose, there was only tax purpose. And so the judge said the HMRC wins. So the case ended up in the Court of Appeal because the taxpayer appealed to this decision, and it was decided a few months ago, another 50 pages judgment, where the judge said, first of all, we can use both the 1995 guidance and 2010 guidance, and even the 17 and 2022 if they only clarify previous guidance. Then it mentions when we want to non-recognize a transaction, we should be very careful because the OECD guidance are very careful on non-recognizing transactions. And so let's not use it lightly. And this judge said, well, yes, it's true that covenants are not there, but would LLC 4 really need covenants, considering that LLC 4 was also controlling LLC 6, and so at the end it could have done anything with the participation there, so it would not have requested any covenant at the end, but it would have still granted a loan. So basically the judge on the transfer pricing issues said the taxpayer is right. This transaction would have happened between two independent parties. On the unallowable purpose test, however, the judge said where there is no commercial purpose, there is only tax purpose here in this situation, and so the tax administration wins. Even if the taxpayer won the transfer pricing discussion, lost the unallowable purpose test, and the judge said, well, then in that case, this loan, the interest on this loan should not have been deducted. So also here a few considerations before giving you the floor. Again, some similarities, the reliance on expert opinions, and also here the importance of setting up contracts correctly since the beginning, because also here, if the taxpayer would have included covenants in the loans, probably the way there to the solution would have been much more straightforward, at least on the transfer pricing matters. In this case, there is a little bit of a peculiarity compared to the other case that concerns the discussion between transfer pricing and other anti-WRC rules. So you see that in this case, the taxpayer ultimately, or at least in the Court of Appeal discussions, has won the transfer pricing points, but not the other anti-WRC points. So always be careful to check not only transfer pricing rules, but also other rules that might challenge your transactions. OECD also here, transfer pricing guidance, these were considered as important. However, it's a little bit confusing what version should have been used. The three judges used different versions. there was a discussion between considering the specific transaction between LC4 and LC5, and eventually the broader approach, considering that LC4 would not have needed covenants if we consider a broader approach. So also here, something interesting in the transfer pricing analysis, whether to use a specific transaction or the broader approach. Contractual arrangements versus actuary delineation. This is a big discussion that will come more and more in the future after the amendments post-BEPS to Chapter 1. And in my view, it's true the taxpayer did not include covenants in the contractual arrangements, but accurate delineation teaches us that we should go beyond contracts. We should really look at what two independent parties would have done. And if two third parties would have included covenants, then why not to consider them in the analysis? This was actually something that in the Chevron case in Australia was also confirmed, and the OECD guidance also confirmed in paragraph 143, 145. So in my opinion here, probably the taxpayer could have raised this point. On delineation versus recognition, the discussions were a little bit, so the old discussions were about delineation and recognition. They didn't make very much of a difference between the two issues. In my view, those two steps should be separately discussed and not taken as one single step. There was also no discussion on functional analysis of capital structure, credit ratings, and I would have expected a little bit more details on this. And the focus, opposite from the previous case, was very much on delineation, but not too much on methodology, on how to apply the correct method, on benchmarking, pricing, and so forth. So if discussions were going also in that direction, yes, it's true, we can include covenants, but if we include covenants, they would have decreased the interest payments. So this is a point probably in favor of tax authorities. But on the other hand, if we include parental guarantees, then this would have increased the interest payments, and this is more of a point in favor of a taxpayer. Also here, I leave you with the links to the cases and contact details as before. We have only 10 minutes left. I've been a little bit faster on this case because I wanted to give you the chance to ask questions also about this interesting case.
So, Coach, do we have any questions from the chat room?
Chat room. I have one question. So the discussion of the transfer pricing aspect versus non-recognition is possibly could also be said like a conflict between a specific anti-avoidance rule like transfer pricing versus a more general anti-avoidance rule. And there was recently a High Court judgment in India on this topic where it was held that GARs can coexist and override SARs, or even if the SAR test is passed, a GAR test could still apply. So would you have any comments on that?
This is an interesting discussion that will come more and more, and you see that also happening in the UK, where TP rules are analyzed side by side with other rules. In my view, applying legally, if the tax code doesn't say much about the interplay between the different type of rules, you can apply both rules. However, if you apply both rules, then what's the purpose of having specific rules, specific anti-avoidance rules? If you can always apply GARs, then of course you empty the relevance of specific anti-avoidance rules. So the idea behind a specific anti-avoidance rule is that, you know, if you are able to play within the boundaries of those rules, then you are fine and you're doing something correct. They cannot be challenged. So if a taxpayer has to follow the specific anti-avoidance rules, it makes sure that it's not playing against those rules, but then it can still be challenged by the general anti-avoidance rules. Then there is no purpose in having specific anti-avoidance rules. So in my view, those type of rules should be better coordinated. In absence of a coordination, yes, judges can also say they can be applied simultaneously, and they decide when to apply one, when to apply the other, freely and discretionally, which leaves a lot of uncertainty in the hands of the taxpayer and in the hands of the tax authorities, because the judgment can go both ways. Any other question? You're probably tired. I think it's evening there, and it's a Friday evening, so the beginning of your weekend. So I'm sure that you have better things to do than discussing transfer pricing issues. And so I'm really grateful for all of you that have been investing 1.5 hours of your Friday afternoon and evening in this, rather than in better discussions. So, yeah.
I think it was interesting to end on a academic note on the weekend as the weekend starts. It gives us some food for thought, something to read upon, reflect more. So I think you summarized a very complex case as simple as you could by giving your final points, you know. In fact, I think I did read your blog as well on this topic, and it came out in a very succinct manner. So thanks, Raffaele. But if there are no more questions, then I'll hand it over back to our chairman of the Western IFA committee, Mayur. Yeah, you're on mute.
Yeah, thank you. Thank you very much, Karishma and Dr. Raffaele, for this excellent session. It was quite interesting and interactive as well. You answered all the questions. Karishma also chaired it very well and intervened and supplemented comments with her comments analysis. Sir, we have some revenue officials also joined on this program today, and we are thankful to them. And it was really interesting. So now I request Prerna to propose a very well deserved vote of thanks to our speaker.
Sure. Thank you, Mayur sir. So thank you so much, Raffaele. I think this was really interesting discussion, and you really summarized all the cases very well in a very simplistic manner, as Karishma also rightly said. So thank you for sparing your valuable time, and thank you so much, Karishma, for giving your inputs wherever it was required and chairing this session really well. So on behalf of IFA, I would like to give you a hearty vote of thanks. Thank you so much.
Thank you. Thank you all. Have a good weekend.
Yeah.
Thank you.
Thank you.
Namaste.
Thank you.
Talk soon. Bye-bye.
Bye-bye.